Hello everyone and welcome back. Thank you for joining us for this BKL budget webinar. They say a week is a long time in politics. Well, 1 hour can be a long time for a webinar when there's very few substantive new measures being announced. Is that good news? Well, let's see. Joining me, Anthony Newgrosh, to dissect yesterday's announcements in forensic detail, we've got Geraint Jones. Hi, Geraint.
Hi there.
And Chris Smith.
Hi, everyone.
Okay, so yesterday's budget. Let's just chew the cud, as it were. What did we like? What didn't we like? What was, more importantly, in many respects, conspicuous by its absence? Geraint, what were your sort of headline thoughts on all of this?
Well, I think you need to look at the budget in conjunction with the March budget and the intervening announcements that the government made between then and now. Clearly, last March's budget was a tax-raising budget, and the most recent budget was more of an autumn statement style expenditure orientated series of announcements. So in terms of what I liked beyond the main headlines, I did like the announcement there'd be a consultation on the re-domiciliation of offshore companies into the UK. I thought that looked a very promising area. The main stuff I didn't like was the lack of any real information about how we're going to pay off the national debt. If you look at historically how many times this country has run a budget surplus since the Second World War, it's tiny, and on each occasion the surplus was wafer thin. We're currently sitting on a huge national debt. We have to have some idea about how we're going to pay it off in the future, and that was conspicuous by its absence.
Well, just to put this in context, I mean, we've got a budget deficit about the size of Norwich's goal difference at the moment. The Chancellor, you're right, he sort of trailed it almost as a giveaway budget, but I think if you look at the numbers, this is a revenue raising budget by about £60 billion. So he had a choice. He could spend or he could cut taxes, and he's gone for the spending option, it would seem. But Chris, any thoughts on the headlines from you?
Not really. I mean, we were quite surprised by the silence, I guess. As Geraint said, it felt very much like a statement, autumn statement, as opposed to an autumn budget. I mean, I'm sure there'll be lots of relief regarding the no mention of CGT increases. I guess that's classed as positive for a lot of people. That'd be good news. But yeah, I guess it was fairly quiet all round.
Yeah, as you say, no CGT changes, no changes to pensions taxes. We did dodge a few bullets again, and what was also, I think, conspicuous by its absence is often the devil's in the detail, isn't it? There's a number of announcements that are perhaps alluded to but squirreled away in the detail. There seems to be very little nefarious anti-avoidance rules or anything else that have been announced yesterday. So in many respects, as we said, pretty light. But as has been highlighted, the average household is going to be £3,000 worse off since Boris became Prime Minister. So there is going to be some pain along the way, it would seem. So, OK, I think if we're talking about pain, we should probably start with personal tax rates and allowances. Over to you, Chris.
Well, again, there's not really much for those that attended the budget webinar back in March. This is the same slide. It hasn't changed. So looking at the 21-22 rates, we're carrying forward. I'd love to really be able to explain more on this, but it is what it is. The real obvious points on there aren't so much about increases in allowances and so on. It's just making sure. I think that the planning point, people do use the allowances. We've got fairly generous ISA rates. We've got consideration about starting savings rate where it can apply. What's not on there is the junior ISA rate, and I think it's back to basics and making sure that these allowances are actually being utilised and used, essentially.
Okay. And we've got the classic Chancellor's trick of what we call fiscal drag here, haven't we? Keeping rates fixed and collecting more money through inflationary increases.
Indeed. I mean, I guess it's going back to it again as to whether we are going to see this trend of an autumn statement being more of a statement piece, an economical statement piece, rather than a budget. I guess the closing speech by the Chancellor yesterday being very much that he's intending on bringing taxes down, or he'd like to bring taxes down going forward. And I think we were saying it's 2024. I think we were saying in the Parliament. So and maybe going forward we'll see a little bit of a reduction on the taxes, or with allowances maybe staying at the same. I don't know, Tony.
Okay. All right. Well, let's deal with the elephant in the room, which is this 1.25% increase in NIC. Effectively, been rebadged, as seems to be the way. But Chris.
Yes, this is the big hit that we saw back in March, which run the maths. It for everybody, it's quite a hit. It does affect employees, employers, self-employed. And as we'll go on to, we'll see as well. There's an increase in the dividend rate being the same. So all round, it's a big recoup of money. I guess is the big point. You'll see the rates there. It's quite evident. It's across the board. The standout point is that there's no cap on this. It doesn't hit an upper earnings limit on national insurance, and that's it. It does go and beyond. So typically, somebody on £100,000 a year salary, it's around £94, £95 a month, I think it is. So quite a hit on the employee, and obviously the employer at the same time. It does. Therefore, with the employed, certainly it gives him scope for things such as salary sacrifice. I think that's what we've certainly seen, an uptake of salary sacrifice queries coming in over the last few months. The real interesting one for me, I think, is the electric car scheme. That's one we've seen, and we're consistently making recommendations to companies who offer this service. For those not aware, for the employee, it's essentially the ability for the employee to obtain an electric car at what would be perceived as a reduced rate, because they're sacrificing gross salary, therefore obtaining a tax and national insurance benefit in doing so. So it brings the cost of having the car down. We've seen the cost of Teslas, for example, will be generally around the £400 a month. Or the lower end of the Minis and Peugeots being £200 a month, so very cost effective. For the employers, it's potential for the employer NIC saving, and as a good opportunity to offer something to employees, so to retain staff. It works equally the same with pensions, so a little bit more into pension planning, I guess, is a consideration. And it's other than that, there's not much we can look around on it. Of course, we've got this comes in April 22, so potentially bringing forward dividend payments, bringing forward director bonuses, some just increase to just before this comes in is of course it's there. But once it's in, to be able to have any savings post April 22. Quite difficult. The basics I can think off the top of the head will be potentially drawing down the director's loan accounts being one. We've got the option where commercial rent's being paid to directors, potentially look at increasing that rent rather than salary. So a couple of basic bits, but I think all round this is the big hit.
Okay, well, let's talk. You talked about dividend rates there. Sorry. Do you want to just highlight what the changes are there?
Yeah, I mean, it's just the 1.25% across all the bands, ultimately. Say it's April 22, so the consideration really, run the maths on it. Are we better off just paying a bit more pre-April?
Yeah, those are the rates for individuals. Do you want to just confirm what the rate is for trusts on dividend income?
I don't think it's changed. It's at the 45% rate.
That's my understanding as well.
Okay.
However, I mean, if you look at these rates here, the highest rate of dividend tax is going to be very nearly 40%, 39.35%, and that's post having paid a corporation tax rate as well, which in time could reach 25%. So the marginal cost of getting money out of a company via a dividend is becoming increasingly high.
It certainly is, and on that point, let's just have a look at this pretty chart we've joined up. Thank you, Sam, for this, which is comparing effective tax rates for taking money out of a company or being self-employed. We could take dividends, we could take salary, or you've got the self-employed routes. And I think, well, I'll let you guys chip in a minute, but it still seems to me that dividends generally are slightly more tax efficient than salaries. Not hugely surprising considering both rates have gone up. You still may have, it still may be cheaper to be self-employed where you've only got one layer of tax, but obviously commercially it's not quite the same option. But as you've alluded to there, Geraint, effective tax rates well over 50% for taking money out of a company these days. So however you do it, it's still pretty expensive.
What that graph doesn't, of course, show is what happens if you retain money within the company. This is based on a 100% extraction model. The one benefit of the company that remains is the ability to only take the money out that you need, and you can stockpile the rest, almost money box it, and then maybe hold it there and then just draw down on it when you've retired, or when you're taking a career break, or when you've got some expedient reason to do so.
Yeah, absolutely. And I think what you just referred to just highlights the ever-increasing tension of the tax system. There was much talk about aligning CGT rates with income tax rates. It didn't happen. But now we've got CGT rates as low as 10% under entrepreneurs relief, or I should say more correctly, business asset disposal relief. So as you said, Geraint, you could stockpile the money in the company, liquidate when you retire, and as long as you don't do anything similar within 2 years broadly, first £1 million at 10%, as opposed to taking the money out as you go along where you're paying over 50% rates. So something's going to have to give there, I suspect, eventually. But for now, as we'll talk about, CGT rates unchanged.
Additionally, Tony, the point is this is not, don't forget the family investment company side. It's very easy to look at this slide and think probably self-employment's better off. As we said, it's not necessarily for going forward options, but family investment as well, bit of flexibility. You know, it's quite key not to just take this slide on face value.
I think you're absolutely right, and I think we should highlight that point. I mean, dividends versus salary, we shouldn't purely be driven by the tax numbers here. There's, of course, you do want to take some salary to get your pension stamp, for example. We'll talk more about R&D tax credits later and the changes there. But if you are able to claim R&D tax credits on your salary, if you're the director who's in your white lab coat doing the work, for example, and we can claim those enhanced tax breaks, then salary might be the way to go. So yes, absolutely. We're not suggesting dividends is always the right answer. We certainly need to look at it in the round, but it's certainly indicative that dividends, do still remain slightly more tax efficient. Any more comments on that, gentlemen? If not, we'll move on to some of the business tax changes. But apologies, I should have mentioned this earlier. Do please feel free to type in your comments and questions. We will try and answer them either as we go along or after the talk. If they're not ones we can deal with at the time, hopefully we will try and come back to you later. But
so those I can see a question that's come in. I think we'll just quickly deal with it. Was the health social care levy? The point I didn't really stress was that initially this is a national insurance increase from April 22. It does revert to a levy in April 23. I haven't heard of it being temporary at this stage. I think the fact it's moving to a levy gives, if you like, the scope for it to be there longer, dare I say, and that may sit and potentially NIC movements may occur. But I think that, and equally, the levy could be adjusted. I think that from an admin point of view, it's going to be easier for HMRC to administer and payroll departments to administer if it's functioned out as a separate levy. But I certainly haven't heard of a potential a year or two, and this vanishes.
Okay, all right, thanks, Chris. Okay, let's move on to the business taxes, and a lot of this is just confirming or just expanding upon what we already know. So let's just talk about corporation tax rates. Yes, it was previously announced that corporation tax is going up to 25% from 1 April 2023. Still broadly internationally competitive, but a fairly substantial 6% increases coming our way. There will, though, for smaller businesses be a 19% rate. We've got our old friendly small companies rate where profits are below 50,000. If you're between 50,000 and 250,000, then there's this marginal rate of tax as you catch up effectively on your tax saving on that first slug of profits that have only suffered tax at 19%. That marginal rate of tax is going to be 26.5% if you do the rate. But so-called close investment holding companies won't benefit from that. So close investment holding companies, this is when it gets frustrating. We start reintroducing measures that were abolished some time ago. These are companies that, well, hold investments, or even companies that rent properties to connected parties are also close investment holding companies for these purposes. Straight 25% for them, no matter what their profits. And as expected, there are rules that adjust those limits if you've got a short accounting period, and also we apportion or divide those limits depending on the number of associated companies. That's again going back in time, as it were. The tax legislation had been amended and simplified only to take into account group companies. But now we're back to the definition of associated companies, companies broadly under common control. And that change also applies as far as looking at whether or not your profits are substantial enough to be within the quarterly instalments regime. There's a number of knock-on effects from that. I have to admit, it did occur to me. I hoped we might have a cheeky little rowback of those corporation tax rates. Go high, suggest 23%, and you can pretend how generous you were. But no, he's stuck at that 25%, and I think we can fully expect that to come into place. As a knock-on effect, the diverted profits tax, that will go up to 31%. As UK corporation tax rates go up, you'll need to revisit whether you have any controlled foreign companies. A company can potentially be a controlled foreign company depending on the rate of corporation tax it pays relative to the UK's rates. So that will need to be revisited. We also got confirmation squirreled away yesterday that's the so-called Section 455 rate of tax. That's the tax that a company has to pay when it makes broadly a loan to a shareholder. That's going up in line with the increase in dividend rates. So that is also going up to 33.75%. And we'll mention it for completeness, but I can't see it's too relevant. The bank surcharge remains at 3%. So if you're caught by that, 28% rate of tax. So again, there's nothing particularly new in all of that. That just confirms what we already were told. There's one extra point in the bottom of that slide, the abolition of cross-border group relief. That's going to take effect with immediate effect. Now we're outside the EU, and that was a bit of a common theme yesterday. Very reluctantly, the UK government had to give force to cross-border group relief. This was the old Marks and Spencer's case. In reality, the rules were so pernickety and narrow, etc., etc. You could only surrender off across border if, for example, there was no other possibility of those losses ever being used, which was highly unlikely. Anyway, it's gone now, so I suspect in many respects that's almost a simplification. What I have to admit I didn't fully appreciate at the time when these changes in rates were announced was the linkage to this next point. Again, we've seen this before. The 130% first year capital allowances rate. So this applies, it's only to companies, not business, unincorporated businesses, for expenditure incurred between 1 April 21 and 31 March 23. So we're now talking about 130% deduction on qualifying investments in plant and machinery. So anything that would have gone in the general pool, if it would have gone in the special rate pool, so that's things like your air conditioning, etc., your integral features. Previously, they've got a fairly miserly 6%. Well, okay, 50% for those. So not bad, it may seem. There's an exclusion. All the usual exclusions are there, really. Second-hand equipment, cars, long-life assets. And one welcome change at the 11th hour was these rules and these reliefs are now available to commercial landlords on background plant and machinery in the buildings. That wasn't originally envisaged. It was originally caught out by the exclusion for leasing assets, but specifically they've changed the rules there. So good news for landlords, having taken a bit of a hammering over the previous years. As a consequence of these on the face of it, quite generous reliefs. What about disposal proceeds? Well, they're fully taxable. If I'm giving you 130% deduction up front, you tax those proceeds in full rather than taking them to the relevant capital allowances pool where they effectively unwind over time. And if you've had 130% deduction, then the disposal value is taken at 130% of the proceeds for assets, not those in the special rate pool then. The one additional piece of good news though yesterday was the annual investment allowance. That was meant to, well, that is currently $1 million. That was meant to run out at the end of the year, but we've got a 15-month extension to 31 March 2023. So how generous is this? Well, not as generous perhaps as it may first seem. As we've said, corporation tax rates are going up to 25% primarily in 2023. If you spent £100 on capital allowances, you therefore save yourself £25 of tax. If you do the maths on this, gross up your £100 at 130% and save tax at 19%, you get exactly the same tax saving. So we'll come back to this point, but there's no advantage to deferring your capital expenditure until 2023, it would seem. If you need the stuff, buy it now. Is going to save you exactly the same amount of tax. And indeed, I think what have been borne out in other overseas jurisdictions is where similar hikes in tax rates have been announced, companies did defer their capital expenditure to try and get tax relief at higher rates in the future. So it's certainly welcome, but perhaps, as I say, not quite as generous as it seems. So those are our capital allowances. Again, apart from the extension as that 1 million limit for the annual investment allowance, nothing new there. Let's move on to the so-called cladding tax, the residential property developer tax. Again, this had been largely trailed. It's a surcharge in respect of profits arising from the development of UK profits, and it's a 4% surcharge on profits exceeding an annual profit of £25 million. There was talk about whether it was fair that it was just an annual allowance with no carry forward of any unused amounts from previous years. Inevitably, in this sort of business, profits can be very lumpy, but no, it's 25 million the allowance, so it's only your profits above that that are subject to this 4% surcharge. And if you're in a group of companies, no surprises, that 25 million allowance applies to the group as a whole. Need to be a bit careful. There are some specific rules as to how you calculate your profits in particular, although such companies are often typically highly geared and interest is a major cost. We exclude those interest costs in looking at those profits, so it may bite a bit more broadly than first thought, but albeit I think the 25 million allowance will ensure that the majority of companies don't have too much to worry about. But this is part of the sort of creeping system we've now got. It's dealt with as part of your corporation tax return, but it is a separate tax, as we've seen with this effective NIC surcharge. The system's getting more and more complicated, but there you go. That extra 4% has been confirmed. Just a couple of the points as far as what's excluded from this for property developers. Well, it's the usual suspects. Student accommodation, for example, that's not in there. Old age homes, prisons, orphanages, all the usual headline items that aren't defined as residential property for these purposes. Just very quickly, I'm going to mention qualifying asset holding companies. Again, there was a consultation on this previously, and the government's now confirmed that this new regime will apply from 1 April 2022 in respect of vehicles or companies owned, at least diversely held. They must be held by certain institutional investors or widely held funds. So it's not simply a case of people just setting up their own qualifying asset holding company. It's for fund structures. Various tax breaks, just very quickly there, certain CGT exemptions on the disposal of shares and overseas property. There's an exemption for overseas rental profits, albeit they have to actually be taxed overseas. And since you probably get DTR anyhow, I'm not quite sure what all the fuss is about there. There's slightly more favourable interest relief rules and certain stamp duty and stamp duty reserve tax exemptions. So, okay, helpful, but I can't imagine that's going to be too relevant to many clients out there. We also had confirmation of the rules concerning notification of uncertain tax treatment. Only applies to large, I'd say very large businesses with effect from 1 April 2022. And large for these purposes is defined where your turnover is more than 200 million or your balance sheet total, I think that means your gross assets for these purposes, is more than 2 billion. But since goodwill won't be on your balance sheet, again, that's not going to affect too many people. Fairly broad as to the taxes it affects, VAT, corporation tax and income tax is included in there. And what do we mean by uncertain amounts? Well, you've made a provision in the accounts and the position adopted is contrary to HMRC's view on the matter. So that may be in their manuals, in the public domain, or in your direct dealings with them. There's consultation as to whether further trigger should be in there, that it's likely that a court or tribunal would rule against the taxpayer. Somewhat subjective, don't like it. We'll see if that's introduced. Only applies where the tax at stake is more than £5 million per annum. So we don't need to worry too much about the pounds and pence. And I think if you squint hard enough, you can probably just about see why HMRC might want something like that. But as I say, I don't think it's going to affect too many people. Just for completeness, we'll quickly mention the rules about the extension of loss carrybacks. Again, this is not new, and I think it's important that we do remember this. We've already got a 3-year carryback available for terminal losses, and that applies both for income tax and corporate tax purposes. We've now got this temporary extension to the loss carryback rules for trading companies and unincorporated businesses. So at the moment, you can only generally go back 1 year. Now, even if it's not a terminal loss, you can go back up to 3 years. There's a £2 million cap for each tax year. That applies broadly to groups of companies. You can still go back, carry back an unlimited amount of losses 1 year. The cap affects the amounts you can carry back to the 2 earlier years. So it's very welcome. Clearly, if there is the possibility of making claims to carry back to those earlier years and recovering tax, then we should do that. So let's move on now to R&D tax reliefs. Again, a bit of a mixture here. The good news is we'd previously seen the consultation on whether data and cloud computing costs should qualify. They will, and that will take effect from 1 April 2023. I'm not quite sure why it's been pushed back, but there you go. I've seen such costs go through without query in the past. It's not strictly correct and won't strictly apply, as we see, until April 23. But good news all the same. It was previously announced HMRC didn't like R&D tax reliefs broadly funding overseas research, and we'll see that message has been reinforced in a minute. So back to the good old days of the R&D tax credit cap. So this is when you're asking for the cash back. The amount of cash you can get back is capped now at £20,000 plus 3 times the company's total PAYE and NIC costs for the period. And that applies now for accounting periods beginning after 1 April 2021. So if you're doing the work in the UK and you've got heavy NIC costs, it shouldn't be a problem. There's an exception to that, and it's an important exception. If the company is creating its IP and broadly not just subcontracting that R&D out to connected parties, then the cap doesn't apply. Again, a little bit subjective and a little surprising, and not unconnected to our exit from the EU again. The Chancellor announced that from 2023, they'd look to further restrict the R&D tax credits to only fund work done in the UK. So we've got no more details on that at the moment, but we'll of course let you all know as soon as we do. But R&D is here to stay, albeit the message is it's very much focused on work done in the UK. There's a number of related reliefs to the R&D, the creative industry reliefs, and here the Chancellor announced some targeted benefits, particularly I think in light of COVID and the hit that theatres, etc. have taken. So I'm not going to go through this slide in detail. The headlines are the rates of tax credit for all of those industries have been increased. The numbers and details are there on the slide, but just by way of reference, orchestral tax relief gone up from 25% to 50%, so quite a generous increase there. So that's all I'll say on those creative industry reliefs, aside from there was also announced some targeted anti-avoidance, but again, somewhat surprisingly, there was no detail on that. So look out. We'll of course let you know as soon as those announcements are fleshed out. What about VAT? Well, conspicuous by its absence. We struggle to find 2 bullet points there for you, but the 12.5% that applies to hospitality, hotel accommodation and attractions, that continues until March 2022. And the only other point we could glean yesterday, there's a consultation to simplify the VAT treatment of fund management fees. And unless you import prosthetics, that was absolutely it on VAT yesterday. So there you go, no substantive changes there. Just a few other smaller points then we'll pick up on. Tonnage tax, quite a niche area for those who have clients involved in shipping. It's an elective regime and there are a few tweaks and designed to make the regime slightly more flexible as to when you can come in and when you can leave the regime. So good news there. The lock-in period, for example, if you enter into the regime is reduced from 8 to 10 years. And they're also now going to focus the regime on UK flagged vessels. Again, bye-bye EU, I think is the message there. A few tweaks on income tax. Chris, do you want to pick those up?
Yeah, it was announcements that were made a few weeks back, making tax digital, which most people will be aware. It is going to come in. It's just been delayed by a year. I suspect it was a half expected delay, I guess, with the COVID pandemic, meaning that systems and staff are probably not working as such, and yeah, it's been pushed back a year. General partnerships 2025 and self-assessment, self-employed individuals earning over £10,000 to 2024. So that was as expected. The reform of penalties, this is for late payment, late submission. And again, it's just been announced it will come in from April 24. I guess the more interesting and I think sensible announcement that's made was the CGT reporting for disposal of UK property. Currently, prior to yesterday, we were under 30 days. We had to submit a return and make payment of tax. That's been pushed to 60 days.
That's for completions after the 27th, I believe.
It's for completions after 27th, correct.
Yeah.
And that's just a sensible change, which was good to see.
Yeah, and that was it on CGT, wasn't it? Quite astonishingly, every time we have these little chats, we're expecting some substantive announcements. But
indeed, as I think a lot of clients are, I think there's a lot of people we get calls beforehand. Everybody trying to do the deals before the dates, and I think a lot of them were celebrating with. I was going to say cheaper champagne, but that's not coming in for a little while yet, is it? But
yeah, we'll come on to that in a second. And the only other point we've mentioned there is air passenger duty. That is to be reduced for domestic flights, but for so-called ultra long-haul flights, we should say there for completeness, from 1 April 2023, you're going to have to pay a little bit more. So, as tends to be the way, a few consultations announced. 2 in particular we picked up on: the redomiciliation of overseas company. It's proposed to allow the inward redomiciliation for companies based overseas, provided you are allowed, in accordance with the local laws, to transfer the company from that jurisdiction. It's going to be a few safeguards, and in the previous consultation it set out sort of tax thoughts around this, how to determine tax residency, what value the company's assets come into the charge to capital gains tax, for example. So we await that space, but I think it's only helpful, as it were, that we're going to potentially be allowed to bring overseas companies into the UK. We have been seen to be a little bit inflexible in that regard in the past. And no surprises, online sales tax, a consultation. The announcement yesterday, we will explore the arguments for and against. I suspect the argument for is it might raise a hell of a lot of tax. So it will be no surprise if that comes in, but nothing definitive has been confirmed at the moment. So watch this space, as it were. But Geraint, tell us about the headline changes on business rates.
Yes. I mean, as you'll all be aware, there's been a lot of complaints in the business community about business rates, and there has been a consultation running for about 18 months now, I believe, and these are the first substantive announcements that we've received. As you can see, there was a 5-year, I think it was, revaluation, now it's going to be dropped down to 3 years. This is going to be of a great deal of benefit because obviously the value of high street properties do tend to change as the years go by. That's with effect from 2023. The government's going to freeze the business rates multiplier for a further year, so that's very welcome. And there'll be a 50% business rates discount for businesses in the retail, hospitality and leisure sector up to a maximum of 110,000. That will be introduced for 1 year. So it's not at the moment getting to the core of the problem of business rates, but as Rishi pointed out in the budget, is raising £25 billion a year. So to screw it up and throw it in the bin is going to be a very, very expensive exercise. I should also say that there'll be a new business rates improvement relief for items such as solar panels and wind turbines and things like that. So I suspect there's a lot more to come on the business rates front as the years go by, but at the moment it's small steps.
Okay, but I think welcome steps we would acknowledge. So that's business rates, but let's get on to the real only bit of good news, I should say, in the budget. Let's talk about alcohol duties.
Right. I don't know why I've been slated to deal with the alcohol duties section.
I think that's something to do with the last Christmas party, Garai, but you carry on.
But as you can see, I think we previously had 15 different rates of alcohol duty. This is now going to be reduced down to 6. And it's going to be done purely on the alcoholic strength of the drink involved. And a lot of the headlines that have been around around the rather childish comment that Rachel Reeves made about the budget only being good for champagne sipping bankers on short-haul air flights. And that is because historically sparkling wine has been taxed particularly heavily for alcohol duties, and because it's now going to be done purely on alcohol rather than any other criteria. But the only bottle of grape-based produce that is going to come down in price is going to be sparkling wines. So that's good news for the British sparkling wine industry, English sparkling wines, and of course French champagne. Beers and cider will also come down in duty as well. So the local publicans are quite happy about that.
Okay. All right, but it's still a consultation, isn't it? So we'll await the final detail. But again, good news is hopefully a simplification and 3p off a pint. So what's not to like?
And it's one of these consultations that it looks as though it's pretty much a done deal. You know, there are consultations which are consultations, and there are consultations which are, this is what we're going to do, and if you can come up with a very good reason why we shouldn't. And I think this one falls into the latter category. Okay,
rather ironic though, on the day that it was announced that 3p reduction in the rate of beer duties, I think the headline in the paper I was reading was beer going up by 30p a pound because of pressure on their wages. So you still might end up paying more for your pint, but so be it. Okay, thank you for that. And that really is it. That was the budget. Just to summarise some of the points we touched upon, things to think about. Do take advantage of that 130% super deduction for corporates, albeit it's only going to save you just as much tax as if you incur expenditure after 1 April 2023. It is, though, worth thinking about deferring other costs until tax rates go up. For example, pension costs, we only get relief on a paid basis. So even if you were to accrue those costs but defer payment, potentially that could get you a 6% turn on the rate of corporation tax. So a substantial increase, and there may be some planning to do there as we head towards 1 April 2023. But in the meantime, very welcome the extension of the annual investment allowance, staying at £1 million until 1 April 2023. If you are entitled to that, and not all businesses are, unfortunately, but if you are, then do make use of that, and also those enhanced loss carrybacks, be it for companies or partnerships and individuals carrying on trades. Increases, as we know, in the rates of salary and dividend taxes. Dividends still looking more tax effective, but as Chris said, there are alternatives, salary sacrifice, particularly electric cars, where the benefit in kind rates are particularly generous at the moment. So very happy to assist and have a chat with any of you if you want to talk about some planning there, but do look at that as part of the wider picture. So we'll keep an eye on the finance bill. If anything changes, we'll let you know. If you want a summary of what was announced yesterday, David Wiscombe has done his normal tongue-in-cheek brass tacks that summarises the changes, and do have a look at our brass tacks. If you're not a member, just drop us a note. We'll gladly subscribe to you on the list, where we'll afford a beady eye on any changes that are announced as these things go through. We will also circulate both a copy of the slides and a copy of this webinar, should you choose to want to listen to it again. So that will be going round. And in the meantime, take care. If you want to get in touch, here are contact details. We're on the website, and I suspect one or two of us might be on Tinder as well too, but primarily contact us through BKL website or drop us an email. And thank you all for joining us. So thanks, Geraint and Chris. We hope to see you all again soon. Bye now.